Hey, Alpha fam, welcome back to another episode of Alpha Commission. On this lovely Saturday morning, actually, we've got a bit of a fake out reversal happening on Bitcoin. Of course, yesterday it was putting in this rising wedge, which they do have a tendency to break to the downside, and this one absolutely did. And so, if you had gone long on that support, of course, you were in for a nasty little surprise as it broke down, but it did manage to find support on this kind of a dotted trend that I have here, where if we just ignore these kind of scammy wicks down below, and I'll show you their context in a bit, but if you ignore those scammy wicks and then you just find the candle closes, then you can see that we actually did put in a bit of a channel trend, right? And so this trend is still continuing. We did bust out of that 3 month long downtrend. So let's just zoom out a little bit and get a bigger perspective. You can see that we have done this a couple times. We did it here, we did it here, we did it here. So it's not a big deal that we have this kind of zone, right? This zone at the top of our downtrend. But this downtrend has defined our path for 120 days, guys. So it's been 120 days. In fact, I may even need to extend this out a bit. It's now been 125 days. Well, maybe I should tighten this up. Nope, 120 days, okay? And we also have this zone at the bottom here, right? We kind of popped in there a couple times during these fake outs as perhaps the market was getting itself into this situation to begin with. We've wicked below it, but largely we have kept our trend to the downside within the bounds of this downtrend. And so, what would be the expectation? The expectation here is that we would be rejected and that perhaps over the next few days we find ourselves finding our way to the downside as the market absorbs that PPI data, the CPI data, and the PCE data, as well as they start to consider those earnings reports, which should be coming in from various businesses, which could drag down the stock market. But moreover, it would alter the way that the P over E ratios are calculated, and this could signal a deeper recession. So we get into some type of recessionary evaluations of the stock market. And since Bitcoin trades with the stock market, and of course the rest of crypto follows Bitcoin, that means that if the stock market gets downgraded in terms of their PE ratios, then most likely Bitcoin is going to have another leg down. Now, that's just statistics. That doesn't mean that it has to play out that way. Since we are testing the top of this downtrend, we do have the opportunity for Bitcoin to bust out of this channel and potentially, first of all, complete this channel that it's forming here. So here we have, we were just looking at the white rising wedge, but now we can actually see that we have this yellow trend, which we've basically been trading the highs and the lows off of, right? And the top of that trend doesn't stop until 22,600. And so that's the 22,000, the 23,000 that I've been talking about in previous episodes as a potential high. We could have spiked up there at any time. In the last iteration of this type of fractal, we kind of popped up extremely fast. We never reached those higher levels, right? But then again, it did have a bit more of a gentle trend. In this case, that channel suggested that it could have gone as high as 32, and it only went as high as the downtrend line. So that's what I'm warning you guys about. we're in a very trappy area. We're trading on the weekend when there's very low liquidity. And so, whales can play various games. They can pop us up here, they can pop us up there. And the thing is, it won't necessarily be reflected on the CME chart, which has stopped directly at that downward resistance. So even though we've broken the downward resistance on the 24/7 exchanges, we haven't done anything like that on the professional exchanges, which will be closed on the weekends and after hours and holidays. So there could be a chance for a little bit of shenanigans being at play on the weekend. And I want you guys to understand that while we haven't broken out of this downtrend in basically, 3 or 4 months, right? So, yeah, basically 4 months. We shouldn't, whatever happens today or tomorrow, we should take with a little bit of a grain of salt, especially as this market prepares to absorb the damage of the potentially negative earnings reports, and then also prepare for the potential damage which may come if the Fed does decide to increase rates by 100 basis points as opposed to the 75 basis points which the market has already priced in. Okay, and so if that does end up being a heavier increase than expected, then the market will likely have to make an adjustment, and maybe Bitcoin doesn't come all the way down its channel, but it could take another stop, perhaps to the bottom of its channel, or perhaps to the mid channel below it on this macro channel, and we could see some, just some nasty shenanigans coming up in the next week and a half. However, we do have to be open minded to that best case scenario, which I laid out in the last episode of Macro Monday. You can go check last Monday's episode. Of course, I did lay out the case that we could have bottomed out and that we may have a summer relief rally, right? Perhaps to end in a double bottom at the end of summer or into fall, or perhaps even Q1 of next year. We could have a potential sustained rally depending on what the Fed decision is. Most likely, this market will not change its trend until the Fed changes policy. There has never been an end to a bear market without the Federal Reserve changing policy. So, guys, I know a lot of people are talking about this or that indicator, top and bottom indicators, blah, blah, blah. Guys, we're talking about a stocks super cycle. We are not talking about a crypto cycle. We are talking about a stocks super cycle. And so when we are looking at all of these macro factors, we can't discount the influences on the stock market, which crypto is correlated with in terms of making our decisions and implying likelihoods. We can't just look at the Bitcoin chart. Now, there is something to say for assets that turned around early in a recessionary, in a bearish setup regarding response to Federal Reserve interest rates hikes. Okay, so often is the case, it's not always the case, but often is the case that whatever assets are reacting first, quickest and hardest in the beginning, they can occasionally bottom out the first. And it's just a function of them having essentially priced in the market changes, uh, you know, front heavy, right? So front loaded pricing in. And so they get ahead of the market. And then if the situation doesn't end up being as bad as what the market decided to price in, then there can be a chance for a quicker rebound than perhaps other assets which were delayed or were waiting for data, right? Now, since Bitcoin actually ended up pricing in some of the damage to the market early on because it is a risk heavy asset, right? It's one of the riskiest assets that you can have as an investor, not in the long term, but in the short term, it can swing wildly by 80%, right? That means that the market dumped those risky assets, including crypto, right away. So the potential is there that crypto could bottom out before the rest of the market. And I just want to put that out there because although it's highly correlated to the stock market, and if the stock market does take a leg down, crypto almost definitely will take a leg down as well. One thing you have to consider is that as we get towards a potential bottom to the market, that ratio may start to decrease and that Bitcoin may actually end up decoupling or perhaps reducing the let's call it leverage against the stock market, the multiplication factor, right? So instead of 3x the S&P, maybe it's only going to do 2x the S&P, or instead of 3x the S&P, maybe it's only going to do 1.5x the S&P. We don't know. We've never seen, Bitcoin behave in the face of a global economic recession, and we've never seen, how Bitcoin behaves in a stocks supercycle reset. So we don't know where the decoupling might come. We don't know what the new ratios will be, or if it's just going to decouple entirely, which I think is completely absurd and people are just dreaming about. But ultimately, there will be a bottom to Bitcoin. For example, it probably cannot be compressed more than $1,000 to $5,000. And that's simply a function of, where it's found support before. And, if we look at the macro, which we can do on the next Macro Monday, there are good reasons to think that Bitcoin probably won't go below 5,000, and there are reasons to suggest that we could potentially have already bottomed out. But the truth is most likely going to be somewhere in the middle, whether it's 10,000, whether it's 14,000, whether it's 16,000, or whether it's just a double bottom or even a confirmation of the low of this yellow channel that we have pushing up here. One indication would be if we do break out of this macro downtrend, you know, how do we respond to that breakout? Do we get a new bull run, or do we just get perhaps a relief rally? And if we only get a relief rally, then what we could be looking at is just some type of, Elliott wave type structure where perhaps we do something like this, and then towards fall we end up making our true low on perhaps a a five wave, Elliott wave, something like this, right? Others might suggest that maybe this is an ABC pattern, but that remains to be seen, right? And then perhaps there could be a five-way pattern to the top side, and people are imagining an all-time high. I think that's a little bit ambitious. Let's just see if we can break out of this channel cleanly, right, in the next couple weeks, or if we take a leg down, or maybe we decouple from stocks, right? But just from our past experience in the last 4 months, you would probably be quite reasonable, right? If you just assumed that we were more likely going to break down soon within this little zone, right? Within this hard red line and this kind of dotted line, that we most likely are going to break down within this area. But you would be forgiven if you wanted to attempt to take that trade to $22,500 or perhaps even to that $23,500, that $23,000 to $24,000 zone, which is the measured move off of this broadening descending wedge, right? So early on in this formation, I had mentioned we were forming a broadening descending wedge. And of course, the measured move on that, once you retest the breakout of a broadening descending wedge, then the measured move for that is the beginning of the breakdown of the original wedge itself. And so if we do have a measured move up to 23,500 and then perhaps come back down and then perhaps try to have a breakout or perhaps, use the top of this channel, that would be incredibly bullish. But if we just end up flicking up here and then breaking back down, that's going to be a big warning signal that perhaps we're going to have a move like this as the Federal Reserve ends up making its decision, and that perhaps we could have one of these downturns, right? So, guys, that's just the current state of things right now. As we get compressed into towards the edge, and we're actually sitting on the edge itself in that resistance zone, we are going to have a couple more questions than when we're in the middle, right? Than when we're in the middle of the range where everything is a nice clean trade. See, if you guys had been trading this area, it was you know, a nice clean set of trades, and you can make a lot of money off of that. But once you get compressed into this area, whether we end up breaking up or breaking down, it starts getting pretty dicey. And so you may want to lay off the leverage just a bit and maybe just take some spot trades, right, until a clear definition is determined. But that's the layout of the land. That's what we have going on. Let's see if we can get anything from our indicators. We still are pointed up on the oscillators. We do have a good money flow. We do have positive curvature, starting to slow down just a little bit on this short length oscillator here, but otherwise perhaps we do have a little bit more fuel on the 6 hour. Of course, the daily is going to just be a mixed bag, but it's essentially the same thing. And if you can just eyeball this, we do have kind of that upward curvature in general. So on the 6 hour and the daily, we're still pretty good in terms of our oscillators. In terms of are we overheated or not? Are we, getting to those areas that could perhaps have our directional volatility just send us back down? I think that we could actually expand a little bit more. There's no guarantee of that. Sometimes we have a spike and then we just drop down to hell. So potentially we could just drop down to hell. But on average, we do get a little bit of a chop here, especially as we have an upward curvature on this EMA associated with it. Our Stokes on the 6 hour here is, well, that's a genuine mixed bag. It is reflecting right now on the 6 hour. On the daily, we still have a positive curvature and will maintain that above $20,400. We are at $21,300, so that probably won't be changing too soon. As far as the 6 hour, yeah, I mean, we're right at a decision moment. So this thing could get knocked down. Let's look at the 4 hour. The 4 hour is starting to turn a bit bearish. I personally like the 6 hour, but the 4 hour is pretty standard, and right now it is suggesting that things could turn down. Let me take a look at our oscillators on the 4 hour. Mm, Same situation. I mean, it is starting to flatline, and it could potentially curve up again, but yeah, just a little bit of a mixed bag there. In terms of our overall volatility, we are pretty low on the BBWP on the 4 hour, and the 6 hour we're also turning up, and the daily, well, we're turning down here. So perhaps this is a corrective move on the daily. Um, not sure. Not sure if this is going to be just one of these mid-range things, or if this is going to come all the way down. So this is a bit of a confusing setup on the 24/7 exchange. Let me look at the CME exchange. Yeah, so for the CME, we are pointed to the upside, but it's a very weird formation. So yeah, I mean, perhaps we could get expansion to the top side. Let's see here. But we are pointed in a downward direction on the daily Stokes. So combining that with the BBWP on the CME chart, it would suggest that we are in that trappy area, which could potentially get a drop down on the professional exchanges, right? Not the 24-hour exchange, but the professional exchanges, which are closed on the weekend. And we also have the potential to turn to the downside. So Sunday night, Monday morning, or perhaps whenever the CME has some open hours, sometimes they have irregular hours. Potentially, we could see a reversal on the CME. And anyway, the 24-hour exchanges and the professional exchanges are going to have to parse that out. So we're gonna see, right? We're gonna see. But keep your eye on this, sloping resistance here. Again, we've been in this formation for, approximately 4 months, right? So if we're going to break out, that would be incredibly bullish for a potential, if not reversal, then perhaps relief rally, right? And those relief rallies can be pretty significant. You saw what happened, guys, when we broke out of our downtrend, over here, right? We had this downtrend, and then we broke out, and the move on that one was a nice 25%, you know, um, basically mean reversion. If we throw on our EMAs, just to give us a little bit of context here on the daily, we're extremely far away from our EMAs on the daily. And so it would make sense at some point to check back with our EMAs. And this would suggest the possibility for a summer relief rally. I know a lot of people want to be super bearish. Others want to be super bullish, but we probably would have to put this just in the context of a relief rally in an overall downtrend. And in my opinion, probably the best case scenario is it would be some type of Elliott wave formation, where this leg up isn't going to violate the high, or pardon me, the low of the first leg down. And so the maximum that we could probably be thinking about is that $30,000 to $33,000 area at absolute max. And then we do have a little bit of a wick right here, which would suggest 25,000 could potentially limit us. Not sure if that's that significant, but potentially, potentially, we could come up to this 28,000, somewhere between 24 to 28,000. But we'll take that as we get there. I mean, this is just a really tiny wick, but you never know where you're going to find some resistance and just smack down. So going by our EMAs, we would really put an upper limit on that of probably 28,000. Just going by structure and the Elliott wave, then 30,000 would most likely be some type of limitation. We also have the 200 EMA in that area, right? The 200 MA will also be coming down as we move, so that will also be in that area. And so these would be good, maximum targets, if we do have some type of relief rally, some type of huge bullishness in this market, because perhaps the Fed isn't as aggressive as people were expecting. If we look on the weekly, you can see that we do have our 200 EMA just overhead. And let me take off some of these drawings. This orange line right here is our 200 MA. We have our 200 MA, which did limit us in the past right there. We have our 200 MA right at approximately 23,000. And so that would correspond pretty reasonably with that structure that I gave for the breakdown of the descending broadening wedge, as well as our upward channels here, where again this yellow channel ends at 22,600. Go back to the weekly. The 200 MA is right there at 22,600. So if we do get a pump, that's going to be a very strong boss that we have to overcome. It's going to be a potential limiter on us. If we are trapped under the 200 MA in this macro downtrend, then that could potentially be just a fake out spot where we just get slapped down brutally and we start to print potentially that fractal that I was talking about from above here, where we just potentially have that drop down perhaps to the mid channel or even the bottom of the channel, right? And then we obviously wouldn't break out. But if we do get above that $23,500 area, we will have broken out from under the 200 MA, which is no easy task. And so if we perhaps bump our head on 26,000, which is the 200 EMA, and then are able to sit above perhaps 24,000 or whatnot in that area, 23,000, and kind of just hang on under that 200 EMA, then as the 20 EMA descends, there could be the potential to pop through that. Now, I'm not going to call any of this type of bullishness. I'm definitely not going to call bullishness in the middle of a macro downtrend, in the middle of a stocks supercycle downtrend. But I will suggest to be open-minded to these moves as I laid out in the last Macro Monday, which you can review that video if you'd like to get just kind of a bigger overview on that potential, macro bottom perhaps being put in. But there is a worst case scenario, right? There's a worst case scenario which I'll be addressing in the next Macro Monday, which could suggest that we could go significantly lower. So, guys, be open minded to both ways. Understand that the weekend is going to be a bit tricky, a bit choppy, and that, of course, everyone is going to be trying to liquidate everyone else. We did get a nice wick to puncture this area on the 6 hour and the 4 hour, but we really haven't closed there yet. And so we do have another hour and a half on the 4 hour. Potentially we could have just broken out of that rising wedge, are checking back in, and perhaps we end up breaking down again, and this was just a double fake out. So stay on your toes. Again, be very careful, be extra careful if you use leverage. Right now, we are underneath we are underneath that long-term resistance once again, having been sent below it and not being able to close a higher time frame candle on top of it. I would love to see a couple 4 hour candles or a daily candle close above this kind of zone here, right? Between this hard red line and this kind of a dotted red line. We can always wick into this area. We can always have a couple candles just kind of in that area, just kind of, tricking us, being a little bit tricky. But if we start closing outside of that, that's going to be a very interesting sign. We can even smash up, tag this line, smash up, tag this line, and then drop back down into that red zone, and then perhaps still head down to the downside in some type of liquidity grab, right? But it's really the higher time frame candles which are going to, give us a perspective as to whether or not we're breaking out of these formations. So first formation is this wedge, that's our current boss. Second boss is going to be this yellow channel. Third boss is going to be this descending, broadening wedge measured move. Let me just turn that one teal to match its formation. And then, of course, ultimately we want to have closures of significant candle values outside of this macro downtrend. And then we're going to be contending with those weekly EMAs, which we were discussing. And just to reiterate, once again, the 200 MA is at that 22,600 mark, and the 200 EMA is at that 26,000, let's call it 500-ish mark. But we also have the 10 right here around 24,000, and both 10s, the 10 MA and the 10 EMA, are going to be converging in this area for kind of a double whammy of a potential rejection goodness around that measured move of the descending broadening wedge, which would suggest that 24,000 is also going to be a very, very strong resistance point, okay? So keep those numbers in mind. 22,500, 23,500, and then 24,000. And if we can get through that, perhaps 26,000, and maybe even as high as 30,000, but I would suggest that's going to be a pretty hard limit, and then we'll have to take a look at it from there. If we do get into those areas, it's going to be an incredibly good sign though, because we will basically start to flip some of the macro structures. All right, guys, I'm going to wrap it up there. That was your alpha for the day. Stay safe and happy trading.